Good morning, everyone. Welcome to Tax Smart Philanthropy at St. Paul's. We're thrilled to have you join us today to explore the significant impact of strategic philanthropy can have not only on St. Paul's School, but on your personal financial planning. My name is Jeff Dudley. I'm the Director of Leadership and Legacy Giving at St. Paul's, and today we're honored to have with us Eric Brotman, a distinguished alumnus of the class of 1990. Eric is a renowned financial advisor, author, and philanthropist with extensive expertise in helping individuals and families optimize their giving strategies. Now, Eric won't like this, but I'm going to give you his stats, and they're very impressive. Please allow me to introduce Eric Brotman right now. Eric is the CEO of BFG Financial Advisors and managing principal of Brotman Consulting Group in Lutherville, Maryland. Eric holds a Bachelor of Arts from University of Penn and a master's degree in financial services from the American College. Eric has been a CFP since 1998, demonstrating his longstanding commitment to excellence in financial planning. Eric has served on numerous boards, including the Maryland State Retirement and Pension System. He currently serves as a trustee for Bryn Mawr School and Stevenson University. Eric is the author of this award-winning book, Don't Retire, Graduate, and a former adjunct faculty member at Village College, which is now Stevenson University. Eric is also, again, a proud alumnus from the class of 1990. Now, just a little background. Eric contacted me this past winter and with a desire to help St. Paul's, and he had a great suggestion. He basically volunteered to produce and host this webinar at his studio in his office in Timonium, Maryland. And he could provide a bit of information that could help the school while bringing benefits to you, the audience, including alumni, former teachers, former parents. So as he will mention, this is not a business prospecting exercise for Eric. No. Rather, he cares deeply about St. Paul's. He continually contacts me with great ideas, and this was one we in the advancement office and the school leadership couldn't wait to take advantage of. Without further ado, please join me in welcoming Eric Brotman.
Jeff, that was so good, but we're out of time. So sadly, we'll just have to take questions here at the end. It's great to be here. I can't believe I'm coming up on my 35th reunion. That's alarming to me, actually, because I don't feel that old.
You don't look that old.
Well, I appreciate you. You're kind. The purpose of today is to talk about ways that we can essentially do well by doing good. And what I mean by that is there are ways to make contributions to St. Paul's and, frankly, any of your favorite charities, but of course today that's St. Paul's, and also to benefit from areas of the tax code and some of the rules and regs that are out there. We're certainly not going to be talking about anything that's pushing the envelope with the IRS. This is all going to be pretty standard, basic opportunities to make a difference and to amplify giving.
That's great. It's a very timely conversation for me as well. I'm about to turn 65 in a couple days, and my wife just retired, and she's at age 70.
Okay.
And so saving is easy. For a long, long time, we just put money in the IRAs, money, save, save, save. But now, how do we take it out?
Well, I mean, that's a conversation that goes beyond just philanthropy, of course, but most of us instinctively know how to build wealth. We know how to build and accumulate just by contributing regularly for 10 or 20 or 50 years. But understanding how to use that money, because a dollar is not a dollar. Some of them haven't been taxed yet. Some of them are subject to ordinary income. Some are subject to capital gains treatment. Some are going to be tax-free. And so figuring out the best way to do that is part of the strategy, and you guys are right in the sweet spot to figure that out.
That's right.
Good stuff. So as Sarah mentioned, I think in the beginning and has put into the chat box, if you have questions during our presentation today, please put them into the chat box. Sarah's going to interrupt me and Jeff as needed, or wait to the end if we have some questions at that point. So let's advance the slides and get started. There are 4 different strategies we're going to talk about today in general. And the first one is qualified charitable distributions, or what I will call a QCD. A QCD is a relatively new from Secure Act 2.0, and it allows some of the IRA money that you've accumulated once you turn 70 and a half to be used for direct charitable giving so that you can avoid paying ordinary income taxes on that money. Because as you know, as you put money into a traditional 401k or IRA or what have you, you're getting a tax deduction for the contribution. You're getting tax deferral as it grows. But then you have this nice big nest egg, hopefully big. You have a nice big nest egg and it hasn't been taxed yet. And the government requires that we begin to take what are called RMDs, or required minimum distributions. Right now, that's at age 73. It is rising gradually to 75. It was for many, many years, 70 and a half, but the numbers keep rising, frankly, because of longevity. People are living longer, and so they're trying to make sure we don't run out of money at 100. Actuarial tables are now running to 121, 125. Yeah, no, for real. Insurance actuary tables, all of them run to the possibility of 121. So you're only halfway there, my friend. So hang in. But nonetheless, required minimum distributions don't begin until 73 at the moment, but the QCD provisions allow you to make gifts directly starting now. Now,
Can I ask you a quick question?
absolutely.
So what was the, I guess Congress passed this rule?
Yeah, this was in part of the legislative package.
And what was their rationale? Why did they want to do this? And why did they pick 70 and a half?
Well, 70 and a half was the age for RMDs at the time. So 70 and a half made sense to me. The rest of what Congress does rarely makes sense to me or anyone else. So I'm not going to put myself in their shoes and say this is what they were thinking. What I will say is that because of the Tax Cuts and Jobs Act that passed a number of years ago, there was a significant change in charitable giving because so few American taxpayers were itemizing their charitable contributions. And we're going to talk a little bit about donor advised funds and other strategies to do that. But under this current legal regime, you cannot you cannot expect that most of your donors, of St. Paul's donors, are going to be itemizing their taxes.
Right.
Most are now taking the standard deduction, which means you're actually not benefiting financially from making a charitable gift. Now, this act, TCJA, is set to sunset December of 2025. So January 1 of 26, we wake up with the rules as if that had never happened, unless Congress acts. And again, some of that will be impacted by the elections that are coming up. You might have heard there's some election. I've heard a little bit about it.
A small amount of
a little bit about it. But nonetheless, that will affect whether this sunsets, whether it's extended. We will know a whole lot more, hopefully, in a couple of weeks. But for the time being, the way the law is written, about 90% of Americans don't itemize. So as a result, all the charitable contributions that were made aren't actually creating a tax deduction for folks. So the QCD was created, I believe, and I was not in the room when this happened in Capitol Hill, but I believe it was created to make sure that charitable giving specifically didn't suffer under this new tax law. And, you know, a lot of nonprofits were very, very frightened when this came out, because even the donors who were doing $50 or $100 or $150 gifts, because of that deduction, felt like they could do a little bit more, and charities were benefiting from that. That's now, for most folks, gone away. So at 70 and a half, you can actually make a contribution directly to your favorite charity of up to, this year it's $105,000. Last year was 100, and that's going to continue to index based on the rules. And you can do that every year. Now, if you are subject to required distributions, and let me explain basically what that means. A required distribution is based on your age. And based on your age, there is a table, a uniform table that says this is the percentage of your IRA or 401k or what have you, actually just IRA at the moment, that requires you to pull out money every single year and pay taxes on it. Essentially, the government said, you got a free lunch for 50 years, we want our money.
Right.
That RMD, historically, it has become an albatross for people, especially people who've built wealth. And we don't know where tax brackets are going to go, but between the national deficit and the fact that all of the pundits are looking at this and saying that the government is not doing particularly well financially, odds are that income tax rates are going to continue to go up.
Right.
As a result of that, this becomes more and more and more valuable. So I actually think that if St. Paul's has donors, let's say there are donors right now who've been giving $5,000 or $10,000 a year, something, you know, generous certainly, and either aren't getting a tax deduction for it or are only getting it against that ordinary income, but they're required to take distributions from their IRAs. If they take this directly from the IRA, send it to St. Paul's directly, not taking ownership of it first, then they can actually write on their 1040 when they do their tax returns that part of this was QCD.
Right.
There is no line on the tax return to do that. So if you forget, or if you don't tell your CPA or TurboTax or whatever you're doing, if you don't tell the people that that's happened, you will literally pay taxes on it twice. So you must absolutely make a note that this was QCD, keep your records in case you're audited, but this is very common now, and it's something we're encouraging people to do.
Right. And if two quick things, just to make sure everyone knows, St. Paul's is a 501c3. We are a charitable organization, so you can make your gift and get a tax deduction if you're going to itemize. And the second thing is we always keep records of your giving. So if you do need them at some point, you can contact the advancement office and we'll provide them to you.
So if you've been making gifts and they've been cash gifts, and we're going to talk for a lot of reasons why cash gifts are not the best gifts to give. Unrestricted gifts are the favorite gifts to receive as a charitable organization, but unrestricted and cash do not have to be, they can be mutually exclusive.
Right.
You cannot make contributions from a QCD from an IRA to a donor advised fund. We're going to talk about that a little bit later. That's another strategy to take advantage of the tax code. But just know that on the QCDs, once you're 70 and a half, even if you don't have RMDs, you're allowed to make generous gifts from your IRA without paying taxes. And in a lot of cases, if you've been writing checks, 1,000, 2,000, 10,000, whatever the checks you've been writing, instead of writing them from your bank account, from your checking account,
Right.
have them done from here. It will reduce your future tax liability on IRAs. Importantly, it'll also reduce your children or grandchildren's future taxes on these IRAs, because Secure Act 2.0 also changed very fundamentally how inherited IRAs are treated. And they are now really, they can be a real tax problem for people receiving them. And we can talk about that a little bit.
If any of the audience or I don't fully understand it, what should we do? Should we contact a financial advisor?
Well, there's a couple of different things. First, I would sooner do my own root canal than my own taxes. So I think it's good to have a CPA or someone who's assisting with that tax process. I also think having a financial advisor is a good thing. My wife and I sit down with a financial advisor every year, despite the fact that that's what I do for a living. It helps to have an accountability partner. It helps to make sure that there's a second set of eyes. It's kind of like if you're a writer, you can't edit your own work. You just can't. You have to hire an editor to do it, not because you don't understand it, but
fresh eyes.
You need a second set of eyes. So I do think it's helpful to have a financial advisor. Certainly ask that question. There are certainly resources online. IRS.gov has all the litany of this stuff, although you'll find the IRS website to be pretty cumbersome.
Right. Good.
Yeah. So let's move to the next slide, if we can, Sarah. And speaking of IRAs, let's talk a little bit about beneficiary designations.
Tell me what, again, just what an IRA is.
IRA stands for individual retirement account. An individual retirement account is either something that people fund on an annual basis or a periodic basis throughout their adult lives because they are not eligible for a qualified plan at work, or they fund in addition to a qualified plan at work. And there are various restrictions to how you do that. But a traditional IRA, just like a 401k or 403b, is money that you're getting a tax deduction typically for your contributions. You're holding that money for the next X number of years in a tax deferred way, but it will be ordinary income, subject to ordinary income tax when you make withdrawals. Right. The IRA is now a really awful thing. This sounds funny, but it's really kind of an awful thing to leave your kids. And I know lots of us want to leave our children in a better place than we are, and we want to make sure that our funds are used in various ways for the family. The problem with an IRA is, let's say that you've put $10,000 a year in an IRA for the last 50 years, and now it's $2 million. When you leave that, right now, your RMD, your required distribution, right, let's say you're 70 and a half, it's going to be about 4%. So they're going to require you to take roughly $80,000 of taxable income, or you can give it to St. Paul's or your favorite charity, but it's going to be $80,000 of taxable income. But if you were to pass away and you were to leave this to a son or daughter or another human other than your wife, if you were to leave this to another generation, they only have 10 years to drain the entire account. So that means they're going to pay taxes on $2 million over the course of 10 years. Now, it can be done in 1 year. It can be done gradually. There are RMDs, even if as long as they're not minors, there will be RMDs for them. And that can really mess them up. And the reason it can mess them up is if your grandchildren might be getting financial aid because their parents don't make the kind of money you do. they'll lose that financial aid. It might be that your kids, I mean, a lot of people when they pass away are 93. Their kids are 65. They're already on Medicare. This will raise their Medicare premiums as a beneficiary at age 65. So
Wow.
so there's all kinds of different things that you're really creating a new tax regime. You're creating higher expenses. You're phasing out of certain things. And so I happen to think that the IRA is a perfect vehicle for charitable giving because it really does eliminate a tax you otherwise can't avoid.
Right.
So we'll start with that. Now, I know there's a planned giving society at St. Paul's. Brooklynwood
There,
Society, is that
there too,
There
because
too,
we,
okay.
we have the Brooklynwood Society
Okay.
for the boys' school and the Ivy Society at St. Paul School for Girls alums. So we're
So
all one school now, but if you're alum of those two, then
well,
that's
my
what
wife
it's
is an
about.
alum of the girls' school. So
I know
we can do both.
you can do
We can do
both
both
out of your IRA.
out of my
and
IRA.
We'll
Well,
talk about that after the program.
for the record, I'm not 70 and a half just yet, but we'll get there. But nonetheless, there are lots of ways to do planned giving. And a lot of times people are a little hesitant to get involved in planned giving because they're afraid to give away control of various assets while they're living in case they need
Sure.
them. Using a charity, St. Paul's, for example, as the beneficiary of an IRA means that St. Paul's isn't receiving anything during your lifetime, but when you pass away, and you could name your spouse first and then the charity second if you choose. But when you pass away, those funds go to St. Paul's, and unlike leaving them to your son or daughter who has 10 years to pay taxes on them, as a 501c3, St. Paul's pays no taxes on them. So
Right.
it's an incredibly efficient thing to leave to charity and an incredibly inefficient thing to leave to family. And then you hear from folks go, well, wait a minute, most of my money is in this plan. If I leave all of that to charity, I'm not leaving my kids anything. And so we're going to talk a little bit about ways to make sure that your family is, for lack of a better word, whole, if that's important to you. But in this particular case, there are ways to use your IRA. And one of the ways to use the IRA, if you want to keep it in the family, is to consider doing gradual conversions to what's called a Roth IRA. Now,
Right.
today, most qualified plans have Roth contribution options so that you as an employee can say, I'm making traditional or a Roth contribution. A Roth contribution is where you are not taking a tax deduction on your deposit. You're
Right.
allowing the money to grow tax-free, but then when you withdraw it based on ages and certain limitations, it's tax-free income, which is a godsend. If our tax bracket goes to 53% from 35, it'll be great to have some tax-free income. You can also take IRA money and move it to a Roth IRA, which requires you to pay taxes on what you move over. The caveat there is you need to pay the taxes from other monies to make this make sense.
Right.
You don't want to pull money out of your IRA to pay taxes to move some of it to a Roth. You've defeated the purpose.
Right.
So if you moved $100,000 from an IRA to a Roth IRA and your tax hit was $30,000, you would need to have $30,000 in some other account to do that with in a perfect world. So there are lots of reasons why people would do this. They might do it because their tax bracket's lower than their kids. You know, if you're on relatively fixed income as a retiree and your kid is a aerospace engineer making $1 million a year someplace, you might not want to leave him or her assets that are going to be taxed. You might want to pay the taxes at your 15% bracket so they don't pay it at 40%. On the other hand, Roth IRAs are not great money to leave to charity because Roth IRAs can go to your family tax-free. So when you're thinking about your estate, your nest egg, there's lots of things included in your estate. It's your real estate, it's your banking assets, it's your insurance death benefits, it's your retirement plans, it's all these various things. Some of those assets are really efficient and helpful to go straight to family, and some are really efficient and helpful to go to charity. And if you do it right, it literally everybody can win. You just have to know the rules.
And who knows the rules? Again, a financial planner,
Financial advisors, CFPs, and tax accountants, CPAs,
Okay.
and frankly, your estate attorney. Your attorney who's drafting these things should know that. It's super important to know that when you get your estate plan done, which absolutely every adult should have, when you get your estate plan done, the verbiage in your will does not supersede a beneficiary designation. So if in your will, I said, I'm leaving everything to Jeff Dudley, he's a great guy. But the IRA beneficiary said, you know, it's all going to Jordy Mitchell, and Jordy's getting the whole thing. He won't hate that.
Right.
But nonetheless, there are ways to do this such that your legal documents will only handle those things that go through probate. And without going down a rabbit hole on the legality of it, The important thing to know is that the beneficiary designations on your life insurance, on your HSA, your health savings account, on your IRAs and Roth IRAs, on your 401ks, all of that supersedes anything in your will. So don't think, oh, I've got my will, I'm done.
Right.
That is not the way that works.
Well, that's great. What's next?
Well, we talked here on the IRA side, there's also something about HSAs. HSAs, health savings accounts, are relatively new, or at least they're just starting to become popular. I've referred to the HSA as the perfect tax planning vehicle because, quite frankly, it's the only account I know of in the United States that allows you to take a tax deduction for a contribution, regardless of your income, to grow the money tax-free indefinitely, and to invest that money. It doesn't have to sit in cash.
Right.
And then to pull it out tax-free for medical expenses.
It's a triple winner.
The HSA is a gift from Congress.
Right.
I used to think the Roth was a gift. HSA is better than the Roth. It's
And
better than anything.
HSA stands for?
Health savings account.
Correct.
So the health savings account, there are limits to who can contribute. There are limits to how long you can contribute and how much you can contribute. But a lot of people treat HSAs like flexible spending accounts or FSAs, and they're not the same.
Right.
Flexible spending accounts are use it or lose it. And if you fund it and you fund too much, you wind up with 4 pair of glasses you don't really need at the end of the year just to use the money. HSAs can grow forever. They are great to handle. And if you're married,
And you can leave them to your heirs, right?
you can, but don't.
But don't. Uh-oh.
Yeah, here's why.
Tell us why.
The HSA, unlike the IRA, doesn't have the 10 years. The HSA, if you leave it to anyone other than a spouse, it's fully taxable the year you die. So what I tell folks is, if you're married, you can pool these funds until you get to a various age, and then you can use those funds for things like long-term care or Medicare premiums or other things when you're retired.
Right.
If you're not married, or if you're widowed or what have you, you should really be thinking about filing claims as soon as you're eligible to do so. And you can file claims up to 10 years in arrears. So so I now have files, medical records with
Right.
all the explanation of benefits and all the receipts and all that stuff, because I could go tomorrow and file a claim for the last 10 years worth of medical bills and take all of that out of my HSA tax-free anytime I want.
Right.
And that's not age banded. You don't have to wait till you're 59 and a half. So the HSA is not meant for your $50 copay.
But you can't donate any funds from the HSA to St. Paul's.
Not while you're alive, but you can name St. Paul's as the beneficiary.
And is that a wise thing to do?
I think so, because if you're not married, or if you and your spouse are both
Right.
deceased, those are assets that can go directly to a charity as the beneficiary without being taxed.
So what you've said is you can make St. Paul's the beneficiary for your IRA,
Mm-hmm.
your HSA,
Mm-hmm.
your life insurance.
You could.
Anything else?
Well, you could also name a bequest in the will, which could be a set dollar amount. You could name as a remainder in the will, which is a percentage. There are a lot of ways to do this as at death.
Right.
What I want to make sure that people realize is some of the giving can be done while you're alive.
Right.
Which
Let's
as
get back to that.
Well, which as a donor, I feel a lot more pleasure from.
Sure.
You know, I leaving a huge amount of money when I'm gone, presumably, unless there's something I don't really know about, I'm not going to know that happened. So I would much rather do it and see the organization enjoy the fruits of that while I'm living, and enjoy enjoy knowing that someone is in that facility or using that, or a scholarship's been paid for somebody today to benefit. So I think it's really important to not cannibalize your annual and your regular philanthropy by saying, well, you're in my will, you'll get it later.
Right.
That's not good for the school. And frankly, it doesn't feel good to me. I wouldn't want to do it that way.
Right.
So I see Sarah changed the slide already. She's always rushing me. But we went to it's okay. We'll talk about life insurance. All right. So life insurance, you mentioned life insurance. Life insurance, you can leave a charity life insurance dollars as beneficiary. I don't think that's the best way to use life insurance, though.
Tell us why.
There are better ways. Well, partly because your heirs can receive life insurance death benefits income tax free. So there's that. Secondly, life insurance, if it's used, is the perfect vehicle to replace for your family the money you're giving to charity from your IRA. So in other words, if you have $1 million in an IRA and you have $1 million life insurance policy, and you name the charity for the IRA and your family for the life insurance, when you die, the $1 million from the IRA goes to the charity tax-free, and the life insurance goes to your children as $1 million tax-free. And what you did was essentially pay a premium for your lifetime to make sure your family doesn't lose the $1 million in the IRA. and the
Okay.
charity still gets all of it and doesn't pay taxes on any of it. No one pays taxes on any of that, at least not income tax. There might be a state tax, which we can talk about, but from an income tax standpoint, that's the better way. Now, one caveat, we've seen a number of clients and a number of folks who we know who are using life insurance while they're alive to make gifts to charity. So, for
Right.
example, what I could do as a donor, if I chose, is I could actually have St. Paul's apply for, own, and be beneficiary of a policy on my life. You say, well, why would St. Paul's do that, other than the fact that they're hoping I play in traffic? The short answer is that I'm going to pay the premium in the form of an annual gift. I'm not going to write a check to an insurance company. I'm going to write a check to the charity. So my check is now deductible. It could even come from a QCD, depending on your age. You
Right.
can get a lot of benefit from writing that check. And instead of writing it to XYZ insurance company, you write it to the charity. The charity then writes a check to the insurance company. And when you ultimately pass away, that is an asset that goes directly to the charity, and there's no income tax.
And that's a conversation you would have with school
Correct.
first.
That is a plan
But
giving office thing. Yes.
before you do that, always check with your financial advisor and tax person to make sure it's the right move for you.
Yeah. I mean, this really, these kinds of things, for the most part, Jeff, are gravy.
Yeah.
You know, there's some blocking and tackling that happens every year as part of your plan.
Right.
And then there's, when you have abundance and you have the amplitude to do this and the desire to do this, there are incredible strategies that allow for these things. And, you know, we're not going to talk today about split interest gifts and all the technical things
Sure.
that are out there. But the fact is, you can leave almost anything you want to your favorite charity, but you need to communicate some of this in advance, not only to your lawyer and your tax people and your financial people, but to the charity. Because, you know, for example, some people will leave their home to a charity.
Exactly.
Which is great. If your kids don't want the house and you want to leave it to charity, you can. You can also, though, make a gift to a trust that gives you a tax deduction today and an income for the rest of your life. And then when you die, the house belongs to the charity who can sell it with no tax and repurpose the funds.
Which is different than getting an annuity.
Correct. It's not the same as an annuity.
Right.
A charitable gift annuity is literally putting in dollars, getting an income, and then leaving the remainder to school.
Right.
Also valuable.
Right.
But if you want to do that with something illiquid like real estate, there are ways to do that where it creates an income for you. And that's a little beyond the scope today, but just know that if you have the desire to make a gift today or at some time in the future that you consider to be a major gift, whatever major is for you, there are tools and strategies that can make that have additional benefits. The life insurance side is very simple because a death benefit is what it is. Some of the other things require some accounting. They might require some trust and some legal work. And I think it's real important not to go crazy overboard and make this so complicated
Right.
that it becomes an albatross for you. So Sarah, if we can go to the next slide. The next slide is about donor advised funds. This is a relatively new concept also.
Let me
Yeah.
stop here because
Yeah.
just the donor advised funds I know have grown. We know in the advancement office at St. Paul's,
Yeah.
the use of donor advised funds have grown tremendously over the last 10 years. Why don't give us a little background on where these came from, what exactly are there, what exactly they are, and what are the advantages?
Great series of questions. A donor advised fund was largely created to make sure that you could do pooling of your giving so that you could make sure you itemized on your tax return. So for example, let's say that you're making a nice generous gift of $10,000 a year to one or more charities, whatever it is. You're doing $10,000 a year, and every year you write a check for $10,000 and everybody's happy. But the $10,000 isn't deductible to you. It's not a QCD, and it's not deductible because you're not itemizing your tax returns. You're taking the standard deduction. A donor advised fund allows you to put $50,000 into the fund, take a deduction for the $50,000 because it's now going to be above the threshold for the deduction
That year,
and then still give 10,000 of it to the charity every year for the next 5 years. So that
Right.
you're still doing the annual funding. And it's not contractual. You don't have to give the 10,000, but it allows you to say, I expect my gifts over the next couple of years to be X.
Right.
I'm going to put all of that in here now, and then I'll use that fund to make direct donations so that there's no additional tax implication. You can actually itemize using a donor advised fund. Now, donor advised funds are mini foundations. And I say that and all the lawyers' fur goes up because they're not foundations. But
Right.
let me share what I mean by that. Historically, there are different types of foundations, some that are family foundations, where a family has $10 million and decides they're going to build something. And if any of you have that, Jeff can't wait to talk to you. So you let me know. But the family foundation, that is a great way to not only inspire giving, but to involve your children and grandchildren and future generations
We
in
have
philanthropy.
we have many families
Yeah.
who have those conversations.
That is an amazing, amazing thing, but it requires a significant corpus.
Right.
It requires a significant amount of money. So if you're a business owner and you're selling your business for $43 million and you decide to take 10 of that and put it in a foundation so that you're not getting quite as clobbered, that's a great way to do it. If you were to win a lottery, that's a great way to do it. Not that I encourage gambling, of course,
Right.
but nonetheless, the foundation really requires an enormous amount of accounting and legal and other work. And it's not designed for people who are making more modest gifts. And by modest, I mean under $1 million, it makes no sense.
Right.
And I don't think a $700,000 gift is modest to anyone.
Right.
But that's when I use that word, that's what I mean. A donor advised fund does not typically have a minimum. In theory, you could put $500 in a donor advised fund and give $25 a year to your favorite charities any way you wanted to. I think that's a little cumbersome for a gift of $500 in the same way that I think, you get to a certain upper end as well. But the donor advised fund is a great way to time your tax deductions in line with your income. So if you're an attorney and you're getting a significant bonus because of something that happened in a given year, that's the year to fund the
But
DAF.
does it make sense to create your donor advised fund when you're about to start receiving RMDs?
Well, you can't put QCDs into a donor advised fund, so I think that's a little different. And what you can do, though, and it's a good point, is if you're getting an RMD that you don't want, you could take that RMD and then put money directly into a donor advised fund at that time. So that absolutely is possible, but it can't be direct. It has
Got
to
it.
come to you and then go
So it
there.
gets taxed.
It's going to get taxed, but you'd essentially get it back if you were
Right.
itemizing.
Can you, all right, so keep going. Donor advised funds,
Okay.
where do you get, who has them? Where do we get those?
Well, first of all, you can do them on your own. So
Like
there
with
are
who?
sites, daffy.com. Literally, it sounds like a cartoon, but it's a way where you can make very small gifts to a donor advised fund, and you can involve your family in that. It's very cool where you can have up to, I think, 22 family members who can weigh in and suggest charities to receive the funds, but the donor is still the one who controls making the actual
Right.
gift. So it's a way for your kids or grandkids to say, hey, there's this organization doing great work, and can we support that organization? And it creates incredible conversation around the
About
Thanksgiving
philanthropy.
table
Yeah.
about philanthropy. So I think that's really valuable. Now, I think a site like that is great for 5-figure gifts, 4 or 5-figure gifts. When you get into larger, if you're thinking $100,000 or $200,000, you can have a professionally managed donor advised fund, and any financial advisor or institution can help set that up for you.
Okay.
We've been using the American Endowment Foundation. That's just where we have gone for that. But there are lots of different charitable groups that will help you set that up. And you can still work with your financial advisor. You can still have your portfolio managed. It's just that it's managed in your charitable account.
Great.
Once it gets into the DAF, it's there. You cannot pull it back out for anything else. It's all going to charity. Now, the foundation has a required contribution every year, and the DAF does not. I think that's going to change. I think the IRS is saying, this is an opportunity for wealthy people to play shenanigans, put a bunch of money in a fund and then never actually get it to charity. There will be abuses, and it'll take half a dozen of those abuse cases to change it for everybody, because that's usually what happens. At some point, I believe the DAF will require a distribution every year. Right now, it doesn't.
Wow. So again, why it's important for you all, the audience, to know that again, St. Paul's is a 501c3. They donor advised funds. Each of them have little different rules, or are they?
They're pretty
Standard.
Yeah.
So what are the standard rules around giving? Usually that it's got to be a 501c3. Are there any restrictions in where the giving can go?
There is a difference between how much you can deduct when you're making a gift to a private or a public charity. Although once it's in a DAF, that's kind of irrelevant because you've already taken the deduction. Right. In terms of maximum giving, I'm actually not aware of a maximum amount you're allowed to give out of that DAF. in a given year. And right now there's no minimum. I do believe they have to be 501c3 organizations. So you
And
can't give
other
to a
than that.
political campaign, for
Right.
example, to do that.
But whether it's capital campaign versus annual
Makes no
giving
difference.
makes no difference. So again, audience, please realize that if you do have a donor advised fund or a DAF, or as like Eric likes to say, Daffy,
I didn't make that up.
I know,
That's a
but
real
it
thing.
sounds like something you would make up.
Appreciate that.
You can donate those funds to St. Paul's, but please contact us because a lot of times we will get a check. Sometimes, I won't say a lot of times, we will get a check or a distribution from somewhere, and the donor's name's not attached to it. And then when we contact the company, they won't give us the name of the donor. So always, no matter, again, whether it's actual money, a gift from a donor advised fund, or when Eric was talking about special gifts like real estate or horses, like if you own a racehorse and you want to give that to the St. Paul's when you pass, contact us because we may say, well, there may be special things we want to know about, but always contact us. We're always happy to talk about that. And of course, we'll always suggest you talk to your advisors.
I'm going to throw something else out, and this is not just related to the donor advised funds. This is in general for most taxpayers. None of us should be giving gifts of cash because in one way or another, we're forgoing some type, with the exception of the QCD, we're forgoing some type of tax benefit by giving cash. And here's what I mean. If you have $100,000 in an investment account, and let's say the cost basis is 70,000, you've paid 70,000 for securities, it's grown to 100,000. If you decided to make a withdrawal, there'd be some capital gains on that. If you withdraw that, you're going to pay capital gains tax, could be 28% in Maryland between federal and state. You're going to pay capital gains tax, and then you're going to have what's left over to give to charity. Instead, you can take $10,000 of securities, if that's what you wanted to do, and give the highly appreciated securities directly to charity. You give $10,000 of stock to St. Paul. St. Paul sells it. They pay no capital gains, and you've just saved money on that. It is especially important to know that you can do this every single year. You can do this every single year when you rebalance a portfolio. So if your financial advisor is rebalancing a portfolio, you want to be in 60% equities and 40% fixed income, and I'm making that up. It's not advice. I'm making that up. But if that's the deal and the stock market has a good year and suddenly you're at 66% equities and you're at 34% fixed income, and so you have to sell some equities to buy some fixed income to keep yourself level. Well, when you sell those equities, they're going to be gains. They might be short-term gains, which are higher tax. They might be long-term gains. Instead of doing that and writing a check from your checking account to St. Paul's, take some of those gains, the highly appreciated securities, donate them to St. Paul's, and then take the 10,000 in cash you were going to and put it back in your portfolio.
So what's the question? And what's the timing? I have a financial advisor. Is the timing now? I contact him. It's mid-October. Hey, Susan, you're my financial advisor. Can you look? I know you're about to do the rebalancing. Does it make sense this year to give? Tell us the question to ask.
Your financial advisor should be asking that of you, quite candidly. But if they're not, or if you're doing it yourself, this is the time because you want to make sure that things get done before the end of the calendar year. Even though you have until April 15th, and then there's extensions on your personal returns, a lot of these decisions have to be made in the calendar year.
So if my financial advisor hasn't asked me, what's the question I ask them?
What you're asking is, do I have highly appreciated securities or even just appreciated securities that I can use as a charitable gift where I then will refund that account with other funds instead of writing a check from my checkbook? This may sound like it's more complicated, and there's certainly an extra step, but it could save real money. And I've seen studies that show that when you actually use the gains in a portfolio for your giving rather than cash, you can eliminate as much as 57 basis points of expenses over time. Well, that's 0.5%. 0.5% on a big account is real money. So if you can do that, it becomes not only a great way to do philanthropy, but a better tax move for you. The other thing is you can take highly appreciated securities and put them in a DAF. So even though you can't take a QCD from your IRA and put it in a DAF, you can donate securities to a DAF. The DAF can either hold them or sell them, and there's no taxes because it's a charitable fund.
So you're a fan of donor advised
I'm a
funds.
huge fan. I don't trust Congress as far as I could punt them, quite candidly, because I always wonder when the shoe's going to drop. What are they going to do next? But knowing the rules as they are today, I think a donor advised fund is something that almost every family of means should have. And
And
when I
what's
say
that
of
mean? Of
means,
means.
when I say of means, I mean people who are making charitable gifts in a year with a comma in them. If you're giving $1,000 a year away, you ought to have a fund,
Okay.
in my
That's
opinion.
that's
This
interesting.
doesn't have to be for only super wealthy, huge donors, because even at $1,000, you could benefit from moving a mutual fund or a stock or something that you own that's gained. You could also benefit potentially from doing 5 or 10 years of giving at once, where you take $10,000 out of your portfolio, put it in a DAF, save the taxes, and then drip that to your favorite charity over years. And what's nice is there's something in the investment world called a wash sale that you have to be very careful about. You're not allowed, for example, you're not allowed to take a loss in a portfolio and then immediately buy that same security
Right.
back.
There's a what 2 week
30 days.
30 days.
So there, you have to wait for the 31st day. So there's a wash sale. Wash sale rules do not apply if the money went to a DAF or charity. So that even now, I don't know why you would necessarily donate stock at a loss, but if you're doing a full rebalance and for some reason that has to happen, you can then still buy it directly back if you choose.
Do donor advised funds are they able to be handed down to your heirs?
Yes, they
Are
can they can continue in perpetuity just like a foundation would.
And are you able to, upon your death, give to St. Paul's?
Absolutely. You can absolutely do a posthumous gift at that point if you choose.
And is it just a bequest or is it a beneficiary? Do donor advised, when you fill that out, do you?
It would not be a beneficiary designation typically. Typically,
Right.
it would be you'd leave instructions, and those instructions could be in your will that if I have a donor advised fund, please give it to 50% this charity and 50% that charity, or what have you, because when it gets received by your family member, it's not a taxable event. They're now handling your charitable fund. You're naming the successor to handle that for you in your absence. They're going to make charitable gifts out of it, and you've given some instructions to your executor. If your executor is not the same person as the person you're leaving the DAF to, they have to have a conversation,
Right.
because that's not necessarily binding. And I don't want to practice law here. I'm not
Right,
a lawyer, but if it's enough money that it's going to make a line item in your will, be very cautious with it. Make sure you have your lawyer look at it and make sure it's been included, and make sure you name the right people in the right way.
Right. Great.
So I think that's everything today. If I could just close with
thoughts?
a couple of thoughts, and then I'll let you, if you have questions, or if there's questions, Sarah, from the audience. Qualified charitable donations, when you do a QCD, if you're 70 and a half and you're giving anything to charity, this is probably the first place I'd go every single year. That's number one. If you have a portfolio of non-qualified securities, meaning a portfolio that's not in an IRA, that's not a retirement plan, I would give serious thought to a donor advised fund and thought to opening it this year before the end of the year, even if you only fund it in a small way this year, because next year is going to be your high tax year for whatever reason. You can always add to it later. But I see no reason not to establish it and have that there, so that when you make a gift, whether it's $100 or $100,000, it can come from an account that's already sitting there for that purpose. So I would encourage folks to do that. And lastly, I think that, well, not lastly, thirdly, I would say absolutely, if you can, avoid giving cash. Give something other than cash that will create a tax benefit for you, that will not hurt the charity. I mean, leaving certain property to charity can be a problem. Some charities will even have to turn some gifts down if they're too complicated or cumbersome. But if it's a marketable security that they can sell in an instant, it's no big deal.
Right.
And then lastly, when you do your estate plan, and I beg everyone on this call to have an estate plan that's active, to give serious thought to reviewing your beneficiary designations and figure out with your financial advisor and your CPA, which gifts do you make while you're alive, and how and from where, and which assets do you leave to family versus charity, if that's something you're inclined to do when you're gone.
Wow. That's great. Thank you.
No, this is fun. I hope this moves people to action between now and the end of the year. I know you are hoping that you'll get a chance to talk to some folks about
Sure.
this
It's
stuff.
always,
But
it's always,
this does not, obviously all of these strategies could work for anybody, not just St. Paul's, but certainly we're hoping that folks will be generous with our alma mater.
there you go. So Sarah, do you have any questions for us?
I do have a question. Anyone that hasn't put their questions in the chat, please do so now. When we make a donation to St. Paul's, what is that money going towards?
Well, if you don't, if all you do is say, here's a gift to St. Paul's, it's placed in the unrestricted one fund, and then it goes to the greatest need. The school will determine how best to use that gift. But we allow any donor to designate their gift to either, again, we call it the one fund, and you can designate it to tuition assistance, faculty enrichment, um, global initiatives. There's a lot of our students take a lot of trips across the world and around the country. So those are some of the options. But if you want to have that conversation, you should contact the advancement office, and you'll see my information at the end of this presentation. So
Yeah.
that's
I
where
mean, there are also, I believe, ways to donate to specific departments or initiatives, the athletics department, the arts department. I'm
Yep.
sure there's ways,
there
and lots of named scholarship funds and other things like that.
you can to establish a named endowed scholarship. Endowment is a fancy word for a savings account. When
I've not heard it called that. I've heard it called a perpetual fund.
it is a perpetual
Yeah.
so basically you give St. Paul's $50,000 to is the minimum to
Mhm.
establish a named endowment, and basically what St. Paul's agrees to do is never spend that 50,000 that corpus, and we will use the interest that's made from, or we invest that with our endowment is right now around $80 million. And so that's managed by our finance committee of the Board of Trustees, and we'll use the interest to whatever the purpose that you designated to. But yeah, that's a great idea.
Well, and we've seen, I've done enough philanthropy with folks to know that there are endowed funds that you can make, whether it's a scholarship fund for a specific initiative or what have you. You can endow them. There are lots of different ways to structure endowments. And I'm not going to put Jeff on the hook to say, hey, do you do all of these? But sometimes you can fund an endowment gradually over time. Sometimes you can structure an endowment to take place when you pass away. You can fund an endowment with a beneficiary designation or other things. Sometimes you can potentially at some organizations, again, I'm not putting you on the spot.
You're not.
Some organizations allow you to do a named fund with a multi-year pledge where you
Yep.
say it's going to be, I can't do 50,000 this year, but I'm willing to do 10,000 a year for the next 5 years. You could have a named fund. Now it won't be in perpetuity, but during those 5 years, potentially that's possible. So, and again, I'm not putting you on the spot. You don't have to
We've
address that.
nope. The best thing to do is whatever your interest is, and it's the most rewarding part of my work is obviously we love all the gifts, but when someone actually leaves, establishes an endowment to leave a legacy,
Mhm.
it's very rewarding work for me because I see how much the donor receives from making that gift.
Very good. Anything else, Sarah, in the chat box or anything you've received personally for that?
That's it from the chat. If anyone wants to post any last minute questions, please do so now. And while we wait on those, I'll skip ahead a little bit to that contact info.
That's what I used to look like when I wore a tie to work.
That's right.
Since COVID, I don't wear a tie anymore.
I know. I contacted Eric last night and said, "What's the dress code?" And he told me button down, no tie, no jacket. So
Yeah.
I followed suit. I didn't want to, come in looking
No, you don't want to look
too
like that. Don't be
fancy.
that guy.
Because I've been accused of that
Well,
many times.
this is designed to be a comfortable, casual conversation. Go ahead and put Jeff's information up there so people can reach him. There's your email address. You are wearing a tie in that photo.
I am
That's
wearing a
professional
coat and
photo.
tie.
That was taken in the Brooklyn Wood Garden area, wasn't it?
That is.
I recognize that tree. I do. I know that tree.
That was last year's
Yeah,
picture. I've had a few scoops of ice cream.
I know exactly where that picture was taken.
There you
It's
go.
real close to where my graduation picture was taken, which I
There,
believe
that's
is still in black and white.
That's true. And I do not have the phone number up there, but it is you can call the main number 410-825-4686. 644-00 if you want to call, but you can just email me.
Perfect. And this, Sarah, if I'm not mistaken, this presentation will be evergreen. St. Paul's
Yep.
will be able to reuse it and share it. And certainly you're welcome to look at this and to share it with anyone you'd like, particularly if there are alums you want to challenge in various ways.
Yep.
This is my 35th reunion, so I'm prepared to go after my classmates pretty hard this year.
There you
We'll
go.
see.
Well, you heard it here.
You heard it here. Anybody class of
he's-
90, I'm coming for you.
Yeah, Eric is now the reunion chair.
No,
for
I am in
class.
fact not the reunion chair. I'm not the reunion chair, but I am going to be a reunion bully.
I do want to say thank you to Eric for not only taking the time to do this, but again, we're at his office. Sarah is part of his team who helps produce such a professional presentation, which we could produce, but it certainly wouldn't be at this level. And again, one more mention, with all the information coming from here, we highly suggest that and recommend that you contact your financial advisor, your tax professional, your legal professional, and just have that conversation with them as well. And I think that's it.
I think we wrapped it up. Well done.
All right, Sarah, thank you so much, and thanks to everyone. I see that Jordy Mitchell.
Yeah, I threw a
was on
shout out to
there.
Jordy. I had
I
to.
know, I
I
saw
had
that.
to. Well, hopefully I just drummed up some additional giving from him. You know,
Well, he's the best.
he's on the hook now too.
All right. Take
All right,
care, all.
Be well, everybody.
Bye-bye.
Take care.